Welcome to the Explainer. Today, we're cracking open the Strategist Toolkit. We're going to see how massive companies decide where to bet their billions, and just as important, how they make the really tough calls that end up shaping their entire future. But first, before we get to the tools, we've got to understand the core problem they're actually built to solve. It's this huge strategic puzzle that pretty much every large organization has to face. I want you to just imagine for a second, you're the CEO of a company that makes, I don't know, everything from smartphones to jet engines. You've got $1 billion in cash ready to invest, so which division gets it? And which one, maybe, do you have to shut down? It's an incredibly high-stakes puzzle, and there are no easy answers. So here's our game plan for how we're going to piece this all together today. We'll define that core problem, then we'll unpack 3 legendary tools strategists use to solve it, and finally, we'll talk about why this kind of thinking is so critical for any business. So, what is the solution to this big strategic puzzle? Well, the answer lies in a concept that really did revolutionize corporate strategy. It's called portfolio analysis. Think of it like this. It's a toolkit for bringing some serious clarity to all that complexity. Instead of just looking at a long list of products, it helps a business see all its different divisions as a strategic portfolio, kind of like an investment portfolio. The whole goal is to figure out which investments are going to deliver the best returns. Okay, let's dive right in. Our first tool, the Ansoff Matrix, is all about one thing: growth. It gives you a simple but really powerful framework for figuring out how and where your company is going to expand. Now, the matrix is built on 2 super simple questions. Are we going to sell our current products, or are we going to develop brand new ones? And are we targeting our existing customers, or are we trying to find totally new markets? And this creates 4 really clear paths for growth. And here's how that all shakes out. Using a brand like Gucci is a great example. Market penetration. That's your safest bet, right? Selling more of what you already have to the people you already know. Market and product development, well, that's up in the risk, but also the potential reward. But diversification? Oof, that is the high-stakes gamble. A brand new product for a totally new audience. Ansoff basically gives you a map of these risks. Okay, so Ansoff gives you a map of where you could grow. But the big question is, how do you fund that growth? That's where our next tool comes in, the legendary BCG Matrix. This helps you figure out where to get the cash and where to invest it. This matrix also uses a simple 2x2 grid, but this time it looks at your business units based on their market's growth rate versus how much of that market you actually own. It helps a company understand the financial role of each and every business in its portfolio. You know, the absolute genius of this model is its simplicity. These metaphors make complex financial stuff instantly clear. Stars are your future winners and booming markets, but boy, do they need investment. Cash cows are your stable, dominant businesses that basically fund everything else. Question marks are the wild cards, the big what-ifs. And dogs, well, they're often the ones you might think about selling. All right, let's put this to the test. Our source material gives us this example of Cofix, a new medicine. It's got a huge 60% market share in a fast-growing market, but it requires a ton of marketing money. So, what is it? A star or a cash cow? Think about it for a sec. If you said star, you are spot on. The key here is the high growth market. Even with a massive share, it needs that constant investment to defend its turf and keep growing. And the ultimate goal? It's always to turn today's star into tomorrow's cash cow. Okay, our final tool today, the GE Matrix, kind of takes the logic of the BCG Matrix and just levels it up. It adds another layer of sophistication from making those big go or no-go decisions. It's often called the stoplight strategy, and for good reason. The analogy is just simple and incredibly powerful. It sorts every business into a green zone for investment, a yellow zone for a more cautious let's wait and see approach, and a red zone which signals, hey, it might be time to get out. So you can see this model expands to a 9-box grid, plotting market attractiveness against your business strength. And you can immediately see the logic. Look at that top left corner. Strong businesses in attractive markets get the green light to invest and expand. Now look at the bottom right. Weak businesses in tough markets. Yeah, that's a red light. So what makes this model so much more nuanced than the BCG matrix? Well, market attractiveness and business strength aren't just single data points. They're actually composite scores based on a whole range of factors. Things like industry profitability, your brand image, your tech. giving you a much, much more detailed picture. So after exploring these three really powerful tools, let's just step back and ask the big question. What is the key takeaway here? I mean, why do these models, some of them decades old, still matter so much in business today? At the end of the day, what these frameworks do is they transform strategy from just guesswork into a deliberate, data-informed process. They give leaders a common language and a logical way to make these agonizingly tough choices, allocating resources not just for today, but to build a company that's going to thrive tomorrow. And I want to leave you with a final thought. This kind of strategic thinking isn't just for giant corporations. You can actually apply it to your own life. If you think of your career as a portfolio of skills and projects, what's your reliable cash cow right now? And maybe even more importantly, what are you investing in to create your next star?